We don't do any real back of napkin underwriting. If a deal hits our buy box, then we're going to fully underwrite it and take a good look at it. Let's look at deal killers right off the bat. Let's look at the location, the age of the property, median household income, the schools, things that don't necessarily aren't directly inputted into the underwriting. And also their underwriting is an art. So it's not necessarily about being the best. It's about what makes sense for you and for your investors and how to identify opportunities. When people are fearful, it's time to be greedy. And when people are greedy, it's time to be fearful. So there's two different types of raising money. There's I need money today, which is a completely different job and skill set. And then there's actually building the capital raising machine. That's the tragedy of property management, is it's the most important, least appreciated, and terribly paid.
I get the question all the time, Rob. It's like, well, how do I find investors? I got a deal coming up. I need to raise $10 million or whatever. Where do I find it? And I think the lesson here is it starts way before you even have a deal in the works. It's all this pre-work, and writing books helps that.
Totally. There's two different types of raising money. There's I need money today, which is a completely different job and skill set. And then there's actually building the capital raising machine, right? If you want to raise money today for a project today, don't write a book. That would be useless and a waste of time. But if you want to raise money forever and build a machine, then writing a book might be a very smart idea.
Yeah, and if you guys, by the way, if anyone's written a book, drop the name of your book in the comments. I'd be interested to see how many of you guys have done some form of a book. Except for you, I saw Jay Scott pop in here. Sorry, Jay, to out you out. Except for Jay, Jay's written like 135 books, so we don't have room for all of his chats here. Multifamily. How come you picked multifamily versus self-storage, mobile home parks? Like, what attracted you to the multifamily space?
It's something that I could readily understand. My family has a background in single family real estate, so single to multi is not a big leap in my opinion, and it's a very common leap. So that's kind of my background. So multifamily was what I gravitated to. Nothing, I don't think I have a unique insight when it comes to picking multifamily, right? It's a you call it a crowded space, and I think that these days there aren't that many truly under the radar asset classes or strategies. So it's not necessarily about finding something that other people don't see all the time.
Yeah, let's get right into the capital raising stuff, because you talk a lot about the importance of building and maintaining strong relationships with your investors, including establishing trust, which we just talked about, the know, like, and trust. How do you do that in like this economic downturn where people are a little bit more hesitant to invest their hard-earned dollars? It's obviously been a little bit tough in the commercial real estate space. Even multifamily is taking a little bit of a hit, and raising capital by many accounts has been harder and harder. But I think you just raised like you just acquired like your largest acquisition to date, right? Not too long ago. Wasn't that like I think it was like I saw some huge number in there. But how do you keep doing that? What are you doing today in this economic environment that maybe other people aren't doing?
I would say it goes back to the machine. That's something that we're always building and trying to build more robustness to. And so I know for some people that doesn't give you a lot of detail. So I'll explain what I consider the machine. Marketing, for those that have studied it, and I'm not a marketing expert, but it's pretty straightforward. You have a funnel and you want to go from people who don't know you to the top of funnel and then filter down. Everyone has a unique journey with you perhaps, but in one way or another, you want to have them filter down from learning about you to starting to like you, know you, trust you, et cetera. And then finally at the bottom of the funnel is they become an investor of yours. And then it's all about investor retention and repeat investors and then referrals. Those are all the signs of a healthy process there. So when it comes to our machine, like you mentioned, we're very active on LinkedIn. We find LinkedIn to be a great place to be active in terms of posting content and having interactions there. And the question that you asked actually is how have we differentiated ourselves such that we continue to be successful raising capital in this environment? And what are we doing today to maintain strong relationships? Because someone may have raised a lot of money up to this point, and then maybe they have a deal that doesn't go perfectly to plan, which I think anyone can reasonably expect that at some point they're not going to have a deal go perfectly to plan. So what do you do then? So I think those are a couple of the key points I think that are most salient to talk about. So first, at a very high level, what I want to say that we differentiate ourselves on is the type of content that we make. So this is like way at 30,000 foot view, it's who we're attracting and the types of investors that we want. And one thing that we noticed when the market was really hot in 2021 and early 22 was there was something that we called hot money. There was new investors coming to the space every day. We called it hot money. And it's hot today, it's cold tomorrow. And for better or worse, we didn't attract a ton of that hot money. And that's because we didn't really speak to them. Our our dream avatar is someone who is more sophisticated. And that's not to say that our dream avatar is better than someone else's dream avatar. It's just different, right? There's a lot of pros to having, let's say, less sophisticated investors, right? There's pros to that, but there's also cons. And so the cons are when things don't go well, a less sophisticated investor is more likely to feel and act emotionally rather than understand the situation and give you hopefully the benefit of the doubt. Whereas, I mean, I've had to have difficult conversations with investors, as anybody has to have difficult conversations. And at the end of them, I go, "Oh wow, that went really well. They get it, you know." And so that speaks to the education and who we've been pursuing all this time. So I think that's one big differentiator. And then I think this is going to sound cliche, but the other big piece of actually handling a more difficult environment where money isn't raising itself today and deals aren't beating pro forma on their own today is just communication and transparency. And it's always you hear those words thrown around a lot, so it's not a unique insight, but it really difficult times really give you the opportunity to shine. So it's almost a shame if you don't have difficult opportunities because how else do you prove yourself to investors, especially sophisticated investors, really savvy investors, you could double their money and they could go, and I've heard these stories. You could double an investor's money and they could go, I'm not investing with that sponsor again. And you go, why? Well, because they didn't communicate and this happened, this happened. So yeah, I think those are the critical things to be focused on right now.
I love how you said that in terms of this is a big opportunity for you to shine, because we have been talking quite a bit about the transparency issue, especially in light of what's been going on recently. A lot of sponsors have kind of disappeared. A lot of LPs are concerned or really pissed is probably the right word, right? And they're pissed about the lack of communication, lack of transparency, and all this stuff. And I think this is a good way to frame that. Like, hey, take this opportunity to shine so that, look, everybody's in trouble or having a hard, not everybody, but a lot of people are having a hard time. So shining that way is great. Ari was asking, I probably should have asked you this ahead of time, but I wanted to kind of save it to sort of a little bit of the elephant in the room too. So Ari was asking how you got started, which is probably somewhere we just kind of followed up at the beginning. But so tell us how you got started, because I think you actually ended up dropping out of college, if I remember correctly. But how did you get started? And then my follow-up to that is going to be, you're probably one of the more younger sponsors out there. So tell me how that's been a hurdle, if not, or if it's been an advantage for you, if it's been a disadvantage for you, your sort of your quote unquote youth, and how you've dealt with that.
Yeah, so my origin story, my business partner and I, we met through Joe Fairless's mentorship program back in 2017 and into early 2018. We met at the Best Ever conference in person in 2018, and that's when we came together. It wasn't a magic like, hey, let's become partners for life. It was just slowly we met, and we started talking every day, started looking at deals together, and it was just kind of a one step at a time thing. And then uh, I'm kind of jumping ahead in the story a
Yeah.
little bit, but once we closed our first deal, then it kind of made sense. Hey, let's make this a marriage. So it was a very casual partnership at first of coming together, which I think is smart. I was very young and he is 17 years older than me. So we have very diverse or very different people. We come from different backgrounds, and that's fortunately for us been magical. It's been a really fantastic partnership. So for me, at the time when we met, I was studying computer science at Carnegie Mellon, but I couldn't escape the real estate bug. I grew up in a real estate family, and so once my gears got turning about from single family to multifamily, I just had to go. So I started just pursuing it and just working on it every day until it became, like you said, such a big. Uh, it was becoming such a big thing that it just made sense to drop out. So uh, this has been basically everything I've ever known, and so far, it's been working out okay.
And do you get pushback when you talk to investors due to your age? And look, you're not the only. I mean, I know quite a few younger sponsors. But is that, how do you deal with that? Or or is that just in my head? It doesn't even come up and it's never an issue.
It's a interesting thing. I used to be very insecure about it when, especially when I was 21 and didn't have any track record or really anything to show for myself. So it was a very scary time to kind of reveal myself. And then over time, as I got myself more confident and also as our company became more of a real entity and something that I could point to as being bigger than myself, I kind of relaxed about being young. I would say that what I've realized recently is I do feel like I never really allowed those thoughts creep in or really used it as a crutch and think, oh, well, I'm young and that's why XYZ thing didn't go my way. But I feel like now I've started to, uh, maybe I'm wrong, but I feel like now we've gotten to a level where we have the team, we have the track record, everything's rolling. And so now when I see like an investor turn us down, sometimes they'll say it's because of the age, but if they don't say it, I kind of have that suspicion. So I up to this point, if someone turns us down, I was like, I get it because we were a young company. But now when I see us getting turned down, I'm like, I think we're checking all the boxes. So I think we're just not checking that one. And we're victims of the way that we've structured our company because of our personalities, I have been the one to step into the spotlight and be the face of the company, which it's worked well for us. But Kent, being older, it would also be good if he was a little more front facing. So we've had the positives and negatives of that.
Yeah, and obviously you've raised $600 million and you've been doing this, even though you're relatively young compared to probably everybody else on this call. I mean, you have been doing it for a little while. Some folks who are even older and just started. Now you are known for underwriting because obviously you wrote one of the books on it, and you talked about having a kind of a unique underwriting process that kind of sets you apart from others. Do you want to talk a little bit about what that process looks like and what makes you feel like it's different from everybody else?
Well, I would hope that it's not different. I would hope it's the same as everybody else. But for better or worse, not everybody underwrites the same. And I'm not trying to say that we underwrite the best, but and also their underwriting is an art. So it's not necessarily about being the best. It's about what makes sense for you and for your investors and how to identify opportunities. So for us, I mean, some of the key features for our underwriting process, which is just food for thought for people. Some people may find this helpful and interesting. Our way to go is we don't do any real back of napkin underwriting. If a deal hits our buy box, then we're gonna fully underwrite it and take a good look at it. And I think that's a better way to go than trying to spend time on a back of napkin. And the way I explain that is we want to pre-qualify deals on a qualitative basis. And then we can try to look at the deal from a quantitative basis. What does that mean? That means let's look at deal killers right off the bat. Let's look at the location, the age of the property, median household income, the schools, things that don't necessarily aren't directly inputted into the underwriting. Because what you don't want to do is you don't want to take all this time to quantitatively underwrite a deal only to kind of see the forest for the trees and go, oh, wait, actually, there's too much crime in this area, right? So we stress the qualitative first, and then let's go. If we know that it's a deal that we would own and we would like to be successful with, then let's underwrite it fully and let's get really nitty gritty because the market is so competitive that you can't really leave any stone unturned. You have to analyze the other income. You have to analyze every expense line and find ways to create value. Because if you're just looking at the deal from an kind of an overview perspective, like everybody else, perhaps, then you're not going to find the nuggets of value that are going to get you to the finish line of being the highest bidder. Now, you don't always have to be the highest bidder to win a deal, but generally speaking, the person who gets awarded the deal is the person who's crazy enough to pay the most. So in your underwriting, you have to responsibly convince yourself to be crazy enough to pay the most. And so that requires a lot of digging in. So that's just at a very high level, our thought process.
Yeah, and I'm gonna. By the way, if you guys have questions, I see a few in the chat, but definitely drop your questions in the chat because I want to make sure that we're answering your specific questions. Rob, I'm gonna put you on the spot because I saw a couple posts or a post, I think a couple weeks ago or maybe last week that ruffled a little bit of feathers on the underwriting thing. I think you made a statement, something along the lines that you think we're at the point in the cycle where maybe it does start to make sense to underwrite exit cap or rate cap compression, as opposed to, the conventional wisdom is, hey, you underwrite at least with 10 basis points higher every year. And that's been kind of the tradition, quote unquote, conservative underwriting. You came out and said, hey, it might be time for us to start underwriting cap rate compression over the next, 5 to 7 years. And obviously that got all kinds of stuff, feedback on that on everyone. You want to talk a little bit about that and how you get to that thought process, or if you want to just talk about it in general?
Yeah, I think it's a very fascinating topic, and it's a dissonant topic. And like you said on LinkedIn, that post, I can't say it really went viral, but it almost went viral, and it was
It blew up. I
not
know I blew up.
not in a good way. But it's funny. It's rep and that LinkedIn post and the feedback from it is representative of of investment psychology and investor psychology, because a lot of sponsors were commenting their feedback and their disagreement, and these are people that have experience and they buy a lot of deals, and they are a reflection of the market, right? The market is just comprised of, quite simply, the sponsors and the owners of the market and the market. So, and that is who dictates prices. And so, by definition, and this just goes back to the cliches of, Warren Buffettisms, et cetera. But when people are fearful, it's time to be greedy. And when people are greedy, it's time to be fearful. So you can see that psychology in that post. And just to, if people aren't familiar with the post, which you most likely aren't, in that post, I talked about the idea that, and I'll kind of have to jog my memory about every single strong detail why, but basically, when cap rates are very low, they're at an all-time or cyclical low. So it made a lot of sense to have a cap rate expansion, to assume that in 3 to 5 years' time, when you exit, you likely are going to see a reversion to the mean, which would mean higher cap rates. And today, we're in a situation that could be the opposite, that we are perhaps at a cyclical high of cap rates, and we will also similarly see a reversion of the mean, which would mean lower cap rates. So that doesn't mean to go crazy and get drunk on cap rate compression and make every deal look like a 25% IRR. But if a deal is checking a lot of boxes, the fundamentals are sound, the cash flow looks good, and the last piece of the equation is your IRR, because you don't know if the sale is going to quite be there because you're widening the cap rate, then you may want to consider, what could the world actually look like? And then there's also discount to replacement cost, which has been a very, very important topic, which also factors into this cap rate analysis, because in one way or another, if prices crash as they have and prices are below replacement cost, that means developers just aren't going to be economically incentivized to develop, and which will mean we will have a supply issue down the road. We don't have a supply issue today, but we will down the road if prices remain below replacement cost, because developers just won't build. And that's where you will have either cap rate compression, because people will pay a lower cap rate for a supply constrained asset because of the future growth for it, or you'll simply see that happen via above pro forma rent growth in your model, and then you can have a wider cap rate. So the kind of the math works out however you want to look at the world. But that was the post, and you could see the dissonance. People were like, "Oh, he's gambling. This is gambling with your money, and run, and this is aggressive," which is fine. And I think it's always smart to think about conservativeness, but you have to realize, if, let's just say that the dissidents of that post are sponsors in the market, and everyone's on the sidelines and everyone's underwriting really conservatively with catastrophic underwriting models, that's going to depress the prices, and that's going to be the exact time to actually go in and buy. And so it's very, very difficult to actually pull it off. And I'm not calling a bottom, and I'm not saying that we are timing investors, but right now it definitely does feel like, given the negative sentiment in the market, that it is a cyclically attractive time to buy, which by definition in your model would mean that you would look at a flatter to even compressed cap rate on exit.
Yeah, and I commend you for doing that post. I mean, whether somebody agrees with you or not, I mean, the fact that you put it out there on LinkedIn and started that conversation, I think just that alone, the conversation starter and the different opinions. I mean, people are in there saying, you're absolutely not, and other people are like, yeah, agreeing with you. So I just love the fact that there was a discussion on the topic. So I commend you for doing that. Let's switch a little about one of the things that you do that is not unique to your business, but not something that everybody does. You're vertically integrated, right? So you've got your property management company in-house, and then I think you also have some kind of a construction platform or something like that. Can you talk a little bit about the pros and cons of having a vertically integrated company versus just outsourcing everything? And just talk a little bit about the pros and cons of that.
Yeah, it's something very important to us, and it was a decision that we made early on. And while it's not necessarily super unique, like you said, to be vertically integrated, there are plenty of firms that are vertically integrated. What was a bit unique about us was how early in our journey we vertically integrated. More people usually wait for some more scale in order to do it. But we were so motivated and so convinced that it was the right path for us that we wanted to make the move early. And that was back when we had about 850 units. So the importance of vertical integration, and this is kind of an age-old argument, is if you outsource to third-party property management and you pay them a 3% property management fee based on revenue, the whole alignment of interest there is broken because they're paid on revenue. So they're not their compensation is irrespective of how they manage expenses. Obviously, you could fire them, but by and large, this third party property management structure with a 3% management fee on revenue is just it's a horrible broken system. And also management companies are terribly underpaid. 3% of revenue is not a lot of money. And what you're asking them to do is the most important job in the entire business. So that's the tragedy of property management is it's the most important, least appreciated, and terribly paid. And what does that mean? That means if you outsource it, you're most likely going to get results that reflect those incentives. So the only way to really do it, this is the thesis, obviously. There are people that are very successful with third-party management, but the thesis is that if you want to do it right, you got to do it yourself. And that's the whole idea.
Ken McElroy talked that funny story about because he's a former property manager. He always says it's like the worst job of all times because if you're a property manager, you get hired and you do a terrible job and the property dives, you get fired, right? And if you get the job and you kind of maintain the property, don't really do anything great, you get fired. And if you do a really great job and you just blow the numbers out and you increase the rents, they sell the property and you get fired. So it's like a really selfless job, but as you mentioned, a critical one of all times. One of the questions, kind of going back to sort of your earlier days as well. When you were just starting out, how did you go about grabbing investors? Because, obviously you not only were you young from an age perspective, but at the beginning, obviously you had zero experience. I mean, you just met your partner from the Joe Fair list. Like how did you go about, there's a lot of first-time syndicators that listen to this. How did you go about finding or going about getting that first deal under contract and finding investors for that first deal?
Yeah, so that goes to a situation which was scenario number one, which is I need money today, right? Which is very different than doing podcasts and writing books and articles and social media and making videos. And that was also at a time where I was very against all those things. I had a very negative relationship with marketing and sales. The way I grew up and just the way I was taught or not taught, I felt like sales was a sleazy thing to do and marketing was manipulative. So I had wrong misconceptions about marketing and sales. And that was very bad because when it came time to raising the money, there was none, right? Because I didn't dig the well before I was thirsty. I didn't put into place the machine and build up these relationships and kind of actually try to prime the pump. And so when it came time to actually raising capital for our first deal, it was really just a scramble. So there was no finesse, there was no skill, it was just brute force. And my business partner and I, we just put in the work. We just emailed and called every single person that we knew. We asked all those people for referrals. We attended every event possible. It was a lot of hard work, and it was also a big moment of leaving your ego at the door and just facing rejection over and over and over again, and just keeping up a good attitude. So I wouldn't say. I mean, it was awesome, and we're very fortunate to have pulled it all off. But it was a big risk, and I would have really only taken such a big risk if I didn't know how hard it was actually going to be. So it was my inexperience and my blind courage that allowed us to even take that leap of faith. If I knew how hard it was, I just probably would have shied away from the opportunity.
I hear that a lot in general. Like if you knew how hard business was or how to build a business, you probably wouldn't have done it in the first place. Let's switch a little bit out over to like market factors, market indicators, because you also talk a lot about that. I know you pay a lot of attention to market forces and market indicators, but probably too many to enumerate here. But you want to talk maybe about the top two or three that you kind of focus on a lot when it comes to these market indicators, whether it's macro or specific to your particular market?
I think uh, today I check treasuries multiple times per day. Treasuries are so volatile recently, and if you're a fixed rate borrower, that's what your index rate is. So if you're looking to lock in a fixed rate and you put a deal under contract assuming a rate of 6, but then treasuries just happen to make a run, which they have been doing over the last year and a half. They've been making record breaking runs. These swings are not normal. It's in a normal circumstance, it would be like a 10 basis point move would be something to write home about. And now 10 basis point move is every day. So with that volatile of treasuries, it's very difficult to pencil a deal and then go and get it done. So it's something that we check all the time, and it's something that we don't have control over, unfortunately, but it's something that we have to check. And if treasuries do run on us as they have, then we have to make difficult decisions and take action, such as trying to renegotiate the price with the seller, walking away from the deal, or pivoting to a different loan product.
Anything else that you look at, or I know that's the main one.
I mean, as far as macro, I just read the typical stuff. I'm obviously following what the Fed has to say and following CPI prints and things like that. Trying to think of something that's actually more unique and helpful for everybody.
Let's talk about like on the show, as you guys probably know, we have a podcast called Drunk Real Estate, and we talk a lot about whether the recession's coming and the impact of recession on specifically multifamily. Is that something you pay attention to, or are you concerned about that if we do have some recession here in the next 12 to 18 months, how that's going to affect multifamily?
Yes, I am concerned about that. I think things are still early in that on that front. Uh, things are the stock market rates are first, and then the stock market reflects the rates immediately, and then real estate is next because real estate's a levered asset. So it will, but it takes time for real estate to transact and everything. That's why there's a maybe 12-month lag from the stock market to real estate, right? Because stocks went down 20% overnight, and then it took quite a while for real estate to have that 20% down market. And then finally, the last thing to actually move is the real economy. So right now, people are still kind of sanguine about the economy, thinking, well, labor market's still good and wage growth is good and consumer sentiment, whatever. But in my opinion, I think things are more negative than what they look like on the surface. And there will, you can't raise rates this much and not have some impact in the real economy. So I'm waiting for us to really feel that and go through a real economy recession, and that will absolutely trickle into occupancy, collections, rent growth, and things like that. So I think what we're doing is, you can't be too much of a pessimist because at the end of the day, the market's competitive depending on what market you're in. But uh, we are trying to be more pessimistic, if you will, and more conservative about the near term performance of our properties and the market.
And that's kind of shorter term, I guess. Do you have any thoughts on where? I mean, obviously, from everything I've read, you're obviously bullish, not only multifamily, but bullish in the market of. By the way, in Texas, do you focus on Houston, San Antonio, Austin, any particular area, just the whole state?
Houston, Dallas, San Antonio. No Austin. Not because it's a bad market, but because we're just trying to stick to fewer markets so that we can be more experts and have more concentration of properties. And then also generally speaking, Austin has had more growth like coastal like market dynamics where cap rates are super low and it's just very, very competitive.
Where do you see multifamily in the next sort of 5 to 10 years, a little bit further out? You got any thoughts of where we're heading in the multifamily space?
Today we're in oversupply, and developers have built a lot of product, and it's going to take some time to absorb that product. But on a long run basis, the demographics remain really strong, and there is still that big shortage of housing. So I think once there's two things, on a long-term basis, demand is still really strong and it outweighs supply. In the short run, we have oversupply. After we get through the oversupply, like I described earlier, because prices have come down while construction costs have risen a ton, interest rates are up, leverage is down, it's very difficult for a developer to get something out of the ground. And I think there's going to be a dearth of new supply when this current glut of supply works through the system. So call it in 26, I think there's going 26 and 27, I think that's where we're going to see a nice rebound in rent growth.
Nice. And then going back to one of the questions I saw here too, like any advice for folks that are just starting out in the syndication world, especially when it comes to raising capital? I mean, we talked a little bit about the importance, I think, of marketing and setting a brand and thought leadership. Like to your point, that's a little bit, longer term, which I think everyone should be focused on too. But if you were talking to somebody who just was starting this journey out, like kind of where you were, not too long ago, what are some of the recommendations you would have them, specifically when it comes to the raising capital part?
Raising capital, I think the biggest thing on that front is overcoming imposter syndrome. That's probably the single most impactful thing that someone could do in their journey. The sooner that you get over that, the sooner you can be more authentic to yourself, create better content that really speaks to your target audience.
Talk a little bit about that. And when you say imposter syndrome, just thinking you're not worthy and that people shouldn't be giving you money, it's sort of a belief in yourself.
Yeah, it's cheesy.
No, I love it.
But it's really true, and it's a catch 22 because you're just getting started. You want to raise capital. You need to position yourself as a market leader, as a thought leader, and as an expert. But how can you be that expert and thought leader if you are just starting out? Right? That's the whole imposter syndrome, and so you have to latch on to niches and specific topics where you actually can be an expert and speak on it confidently. That's a way to kind of overcome that challenge. So, you don't want to obviously lie and or be someone that you're not, right? You need to be authentic, but at the same time, you need to kind of reach for what you truly are confident about and then speak to that. And so everyone has their own journey, everyone has their own background that they can leverage to be that thought leader.
Cool. And again, questions on we're wrapping up here with Rob. Do you focus? Talk to me a little bit about. I know you're like social media is your big thing. Talk to me about getting investors in or potential investors in via podcasts or meetups or any kind of or events or speaking gigs. That's something you also do. And then how do you actually get them onto your? Presumably, you're trying to get them onto your email list so you can have more control over the communication. Tell me about the other forms. Do you use them? Do you believe in them? And then how do you actually get them onto your list?
Yeah, what we've seen is that the most powerful lead magnets for us to find new investors are the books that we published, guest podcasting, and probably LinkedIn. You could also just say social media generally. Some people have awesome success on Facebook. So those are the three that we've seen as great lead magnets. I think the important thing is to keep in mind is you have to meet people where they are at. So if I'm just getting to know somebody, I'm just speaking in general terms, if I'm just getting to know someone virtually or in person, I'm probably not going to shove my new investor form in front of them because where's their buy-in? Why do they care? Right. But if someone, let's just use another example, general example, and let's say someone is super excited, they've read the books, they're like, oh my gosh, I watch your podcast, I saw you there, and this is awesome. That person is a hot lead. They're ready to see my new investor form, right? They're asking for it. So you have to find people where they are and meet them where they are. So if you only have one offering, then you're going to be limited in terms of being able to meet people where they are, which can sound overwhelming if you're just getting started because it's like, well, shoot, I need to have multiple lead magnets. I don't even have any, right? So the first, start with one. You don't have to be on LinkedIn, Facebook, YouTube, Instagram all at once. I think that'd actually be bad. You'd want to kind of start with one and then branch out. And the same thing with lead magnets. You have to have a new investor form, but is that what you should be pushing, right? There's a time and place. So if like you asked about podcasts and speaking on stages and things like that can be those are high value activities. But if you don't have some compelling thing to take people to next, then it's all for naught. Because if you're just hoping to be, if you're just on a podcast hoping that someone liked what they heard and then they're going to go to your website after and just magically do what you want them to do, it's probably not going to happen. I think when it comes to lead magnets, you want to provide $50 of value for free. So figure out what you can create that would be worth $50 and give it away for free. That way you can get people's emails and you can start building a relationship via email.
100% agree. And when you said one offering, I think we were talking about having more than one lead magnet, right? Or you're talking about having more than one deal in the pipeline for different,
No,
more than one offer. Yeah. So then when you
right.
get them onto your list, a lot of people get people onto the list and then they don't really do anything. Obviously, you want to start establishing like the relationship and the trust and that stuff. What's your process of once they get, like I get on your list, are you like now emailing? What are you emailing me? Are you emailing me? Are you calling me? Are you trying to get me on a call? What's your process once they're on your list already?
Yeah, so this is more like marketing 201 or 202. All right, so it's slightly more advanced and again, you don't have to have all this set up day one, but these are the things that you want to be working towards building out. When someone joins your list, you obviously need to fulfill the purpose of why they originally joined the list. If it was because you promised them something that was worth $50, you need to deliver that on that promise. If they came onto your email list through the new investor form, then you want to, in my opinion, have somebody on your team immediately pick up the phone and call them and get in touch. And everyone's process could be a little different. Maybe it's just an appointment setting and then to the appointment, or you're trying to have a new investor call right then and there on the spot and have a 30-minute get to know you. Everyone's process is different, but you want to minimize the time of investor form fill to phone call or Zoom call, right? So you want to compress that time. And then one is not enough, right? If you have one call, it's not going to leave an impression. So you need to, in a perfect world, pick up the phone, talk to them right away, and then have a follow-up mechanism as well. And some of that, I think you need a nice blend of manual and automated. So picking up the phone, that's manual, right? But automated would be an email drip. So if someone comes into your email marketing manager software, then you might send them an email once per week. In my opinion, I don't like to send more than once per week. But some people send like 5 emails every day for 5 days. So you want to give them a drip, which is an overview on the company and some of the most important things about why they should want to learn more about you, why they should invest with you. That's assuming they filled out that form. Right now, you can see the layers and the webs, right? Because they may have opted into your email list because they wanted to download your free e-guide on XYZ, and then you drip them and kind of talk to them about investing with you and pushing them to a call. So you want to mix the automated with the manual. And I'll end on this point, which is, okay, great. You hit them with the manual, hit them with the automated, and then after 4 weeks, let's say your automation runs out. Well, that's where the manual kicks back in because you need a weekly or monthly newsletter that is topical to show people that I'm still here, I'm still relevant. Because if someone goes to your website and they see that the last time your blog was updated was a year ago, they assume that you're dead.
Man, I gotta update my email, my website there. I think I'm dead. No, but you know what, Rob? I think that's important because I think a lot of people are looking for like the magic formula, or how do I find investors? And they're looking for something else. But at the end of the day, that's what it is. I mean, the raising capital part is sales and marketing. And so all the stuff you first talked about, in my opinion, the LinkedIn, the podcast, all the value add that you're providing, that's the marketing, right? And so you're trying to get them into your world. But then once you're into the world, you've got to start communicating with them, establishing those relationships via your email list, providing with more value, getting on the phone. But that's how you actually end up, establishing these relationships with folks. It's by continually talking to them even once they come on your list. So I think everybody is always, especially the new syndicators who don't have an audience, they're always looking like there must be some magic thing that we need to do. When in fact, it is just literally getting on social or starting a meetup or getting on podcasts or starting your own podcast, all that stuff. All right, my friend, I
I'll
told you,
tell you one
yeah,
piece of magic.
yeah,
This is something that maybe I struggle with and other people have it easy, but I'll tell you something that I think is actually magic. Asking for money. A lot of people get so wrapped up into this marketing mode. I'm going to create this email and it's going to go out at 12 o'clock on a Tuesday. And then it's a week later. If they click this, it's going to do this. And they were all wrapped up in marketing and content creation, and then they forget to actually pick up the phone and talk to somebody and say, are you interested in investing? So you can't be afraid to actually ask for money.
Got to ask for the sale at some point. Rob, structuring and raising debt and equity for real estate, and of course, the definite guide to underwriting multifamily acquisitions, two of the books that you've written. I couldn't find the other one, but it's somewhere here in the office. Rob, if somebody was trying to get a hold of you, what's the best place for people to find you?
Yeah, if you want to learn more about myself and Lone Star, you can head over to our website. That's lscre.com. I'll pop it into the chat. On our website, you can check out the different free downloads that we have and kind of some of the stuff that I talked about. Feel free to kind of reverse engineer our funnel. If you found what I was talking about interesting and you want to build it for yourself, feel free to dive in there. And if you want to get in touch with me, you can do so. I'll put my email in the chat as well. It's rob@lscre.com.
If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.